Good day. Let's talk about the extensions of the basic cost volume profit model. So we're going to move beyond the fundamentals, the very fundamentals of cost volume profit. We're going to talk about extensions of the basic model. Specifically, I want to talk about two issues there, dealing with income taxes and dealing with multi-product situations. Introducing income taxes into the basic cost volume profit model does not fundamentally change the analysis. The analysis is still going to be performed fundamentally in the same way. Introducing taxes, though, merely complicates the math. This complication makes the analysis tedious, but does not make it complex. So income taxes we'll deal with first, and then we'll deal with multi-product situations. CVP works well in its basic configuration. CVP works well with single product situations where you got an organization that has a single product or a single service that it delivers. Unfortunately, however, as you might suspect, there aren't that many situations where organizations have a single product. And so the basic CVP model needs to be adapted to deal with multi-product situations. Now, we could do that without fundamentally changing the CVP analysis. But what we're going to do is we're going to add a couple of assumptions, and we'll break that down in just a second here. So let's move first into income taxes. All right, so assume that the owners of Desert Adventures want to generate after-tax profits of 25,200 and their tax rate is 25%. So what is the target operating profit? Well, the target operating profit is going to be the target operating profit divided by 1 minus the tax rate. So we're going to take that profit, this desired of the 25,200 after tax, and to calculate the pre-tax profit, what we need to do is to generate $33,600. The intuition should be straightforward. To generate more, to generate 25,000 after taxes, I have to generate more than that before taxes because I'm going to have some taxes deducted. And that's basically what we're doing here. We're going to divide the after-tax profit by 1 minus the tax rate. So this term, 1 minus the tax rate, is just introduced into the analysis that you're familiar with the basic CVP model. We've got, in our basic CVP model, we have fixed cost plus the profit divided by the unit contribution margin or the contribution margin per unit sold. In this case, we've just introduced 1 minus the tax rate there. And so when we do that, the arithmetic remains the same, and what we end up with the 134,400, the 33,600, we end up with 60 trips. The arithmetic proceeds as it did before. And then you can prove that back by working from sales through the variable cost, calculating contribution margins, subtracting off the fixed cost, get to the net income before income taxes, subtract off the income taxes at 25% of the 33,600, and we get to 25,200. And that proves back that our calculations worked out. It was arithmetic, so no surprise that proves back, but it's useful to kind of see it. Now, when we extend to the multi-product, so that's income taxes. Now let's extend to the multi-product situation. With the multi-product situation, we're gonna take our basic break-even calculation. So the question is, if I got multiple products and I want to calculate a break-even, can I do that just like I could if I only had a single product or service? And you can. So we're going to start with this basic calculation. Our break-even point is going to be the total fixed cost divided by the selling price minus the variable cost. Selling price minus the variable cost, that's our contribution margin. So I'm going to take the fixed cost divided by the contribution margin per unit, and that's going to get me to my break-even point. That's a formula that you should be familiar with from your basic cost volume profit analysis. Now, one challenge to point out at this point is when I have multi-product organization, which again is most organizations, I don't have a single break-even point. I could have multiple break-even points depending on my assumptions. So what we're going to do is we're going to assume that the ratio of sales of one product to the sales of other products stays constant over time. Now, and so that's what we're going to do here with the multi-product break-even point. We're gonna fix the relationship between the product A and product B. We're going to sell 25% of these and 75% of those, or whatever the ratio, the proportions are. We're going to assume that that stays constant. We're going to work in a second here an example where we've got a ratio of excursions, ground-based trips at 25 to rafting trips at 75. So as long as it stays 25/75, all that analysis will work out. If that shifts, if that ratio, if your product mix shifts, then you got to update your calculations. So as I said, you can do multi-product CVP analysis, but it gets more complicated. What we're going to do to calculate the break-even point for multiple product situation, again, we're going to take the total fixed cost, but what we're going to do is we're going to compute a weighted average selling price. So if I got 2 products or 3 products or 4 products, I'm going to compute the weighted average selling price. So what's the selling price of each weighted by the proportion of sales of each of those products to the total sales. So we computed a weighted average selling price. We're going to likewise do the same thing with the variable cost. Because what we're doing here in this denominator is we're computing kind of a weighted average contribution margin. It's weighted based on the proportionate sales of the different products. So weighted average selling price minus weighted average variable cost. Take that, do the calculation, and then run it into this formula. Same formula that you've seen before. It's just I'm working with the weighted averages. And what I'm generally assuming when I do that is that those weighted averages don't shift over time. So let's look through the example here. I'm not going to take time to go through the example bit by bit, but I'll show it to the slides and you can go through those at your own pace. We're going to start with the 75/25. We got the excursion, that's one of our services. We got rafting, that's another one of our services. You can see each one of them has a selling price, each one of them's got its own variable cost, each one of them's got a contribution margin, and then we got a total fixed cost. So what I'm going to do is I'm going to compute the weighted average selling price. So how much of the 4,000 and how much of the 5,000 is going to depend on the total amount of excursions versus the proportion of selling to rafting. And then I'm going to do the same thing with these contribution margins. All right, so again, I'm not going to talk you through the whole thing. I'm going to show you the slides, and I think you'll see the way the arithmetic works. And I might go a little briskly, but certainly feel free to stop the video and digest if you need to. All right, there you have it. Cost volume profit with income taxes, cost volume profit in multi-product situations. Thank you.